Good afternoon, and thank you very much. So, as you said, I'm going to talk about why we think South African assets are too cheap to ignore. And that's really a function of the expectations that we think are priced into South African equities and bonds. And those low starting prices today mean that we think they will deliver good returns in portfolios in the years ahead. And I'm going to share with you a few charts that hopefully illustrate the low expectations we think are being priced in. And the first of those comes from our recent Conversations Roadshow that Coronation hosted, where we polled over 1,500 financial advisors. And you can see from the chart here that more than 50% of those expect returns from global equities to exceed 10% per annum in the years ahead. And we contrast that to South African equities, where you can see that by far the bulk, or sort of closer to 70%, expect returns from South African equities to be below 10%. And that's despite the much lower starting point in South African equities. And when we look in investor portfolios today, we do see high exposure to global equities. And that's understandable, given the good returns those have delivered over the previous years. But we certainly think that the situation today is quite different. And so when we look at South African equities and the low expectations being priced in, we would expect them to deliver in excess of 10% per annum in the coming years. And as I said, I contrast that to the much higher multiples that we see in global equities. Those businesses are really being priced for good future prospects. And as a result of that, they'll need to grow quite strongly in the year ahead for those multiples to unwind and to deliver strong returns. And so for global equities, we would expect returns to be a bit lower, more like 7 to 8% per annum over the sort of medium term. Okay, so just coming back to why South African equities specifically are cheap, what you can see here is the upside to fair value in the Coronation South African equity component of the Balance Plus funds. And if you look at the red line, that's just highlighting the sort of more than decade high in terms of that upside, and contrasting it to in the yellow where you see the average over time. And you can see quite a meaningful gap in terms of where we sit today in terms of the upside to our fair value. And I want to ask you to remember something. If you look at that period of 2013 to 2014 on the chart, you can see that our expectations for returns from South African equities were very low then. And I'm going to show you a chart later to show you the asset allocation in the fund over time. And you'll see the strong correlation there in terms of the amount we had invested in South African equities at that time. So why is the upside to fair value so high today? And what does the chart really mean? Fair value is Coronation's assessment of the value of each underlying stock in that portfolio. So our team of analysts has come up with an assessment of a company's fair value. It's based on our detailed forecasts of medium-term earnings growth expectations, our assessment of this ability of this business to deliver free cash flow over time, the balance sheet strength and the dividend stream we would expect out of each underlying business. And then what we're showing here is the gap between the share price and that fair value assessment. And there are a couple of reasons why that gap is so big today. And the first of those, again, is the starting point and the prices that we have here. It's been a very lackluster few years for South African equities, and many of them are trading on high dividend yields as a result of their low PE multiples and their strong balance sheets. And the second reason for this is really the breadth of value that we see in South African equities. We see three sort of primary buckets of value, and those are the resource shares. I think Patrick touched on those in a little bit of detail. The global shares that happen to be listed here, as well as our domestic shares. And without sort of throwing all sort of resource shares into one bucket there, I mean, the primary characteristics of those investments are good free cash flow yields, reasonable earnings multiples, and expectations of improved returns to shareholders, either by dividends or buybacks in the years ahead. In terms of the globally listed shares that are present here, there are a long list of those that for various stock-specific reasons we think are attractively valued today. And it might be high dividend yield in something like a British American Tobacco, or the strong growth prospects and reasonable valuation in a business like Naspers today, Aspen, Bidcore with its recovery play, Textainer, there's a reasonably long list of those. And then the third bucket, as I mentioned, is really those domestic equities. And that's despite the very real blows that COVID dealt to our local economy. And as a result of that, we rebased earnings for all the domestic companies. We slashed our expectations of medium-term growth. We cut the multiples that we value those businesses on, and yet because of the extent of the decline in share prices, actually a lot of those look very attractive today. And we have seen some resilience out of our domestic sector. We've seen more resilient top lines. We've seen good cost cutting. That should mean that with even a little bit of volume recovery, we will see growth in the operating margins of these businesses. And then we've seen the best of those businesses continuing to invest in their franchises. And for a business example there, I would say something like a ShopRite, consistently investing in innovation, in tweaks to their business model, and that should allow them to eke out share gains in the years ahead, even if the economy itself is very, very tough. And then we've seen a couple of international players come in and make bids for businesses, be it an Imperial or Distill, which again I think underlines some of the value that we see in our market. So I'm just going to ask you to remember the sort of that upside to fair value today, and we'll tie that back to the portfolio allocation in the final slide. As portfolio managers, a lot of our job, apart from looking for this opportunity, is to ensure that it's reflected in portfolios in a diverse way, which means that portfolios themselves, their performance will depend on the outcome of a number of high conviction ideas, rather than the portfolio being too strongly correlated to a single view. And that's very much what we try to achieve. And one of the tools that we use to monitor those exposures is our risk report, which I've shared with you here at a very high level. And I think the first interesting point to make is that an investment in South African equities is only a third of that exposure actually sits in the domestic economy. Actually, by far the bulk of that exposure sits in the international markets, where your demand sources are coming from a variety of offshore markets, and you can see the sort of 2/3 exposure there. The next biggest market that we have exposure to is China, and within portfolios that currently sits at 22% of the total. But again, that exposure can be drilled down into underlying resource demand that might stem from the market or consumer exposures. And while the Chinese political system does bring with it risk, we think that the very attractive growth prospects and the valuations on offer today mean that it too will deliver good returns in the years ahead. And the other interesting part, I think, about the portfolios today and about this investment in SA equities is just how high the exposure to quality is. And you can see again there about 2/3 of the portfolio sitting in shares that we believe have reasonably robust characteristics and are good quality businesses. And the reason there is that the premiums that good quality businesses are trading at in our market are much narrower than they have been in the past. And even if you are paying a small premium for these businesses today, we think that their fundamentals and their ability to deliver superior business growth and defend their earnings bases will mean that they will deliver better returns. And an example here would be something like a Dis-Chem, where we think, again, even in a tough economy, this is a business that will gain share in the pharmaceutical market and continue to deliver growth for its stakeholders. The fourth point I just wanted to share with you here is the relatively balanced sector exposure. Now, each of these sectors can be drilled down to in quite a lot of detail, but you will see there's a reasonable spread of exposure. And then even within something like resources, portfolio managers can go and drill down to underlying commodity exposures and risk factors that we may have identified. So we cap exposure to something like the vehicle drivetrain, where we believe that the future will lie in electric vehicles, and therefore commodities like oil and platinum will have declining risk profiles. And what we don't want to see in the portfolio is too much exposure, again, to a single outcome. Also, maybe of interest in the resources bucket is our recent investment in the gold equities. We think these bring great diverse risk characteristics to the portfolio, but also importantly today, we're able to buy them to a discount to our fair values as a result of their better production profile, the better handles they have on cost today, and the much de-geared balance sheet, which should mean better returns to shareholders. South African government bonds are also offering very attractive yields, and that's true whether we look at the sort of nominal yields that are approaching 10%, or even after adjusting for inflation, the very high real yields. And what you can see here on the slide is a comparison of South Africa's real yields against a comparable basket of emerging market peers. And really, South Africa stands out here. And of course, these are just an EM basket with positive real yields. If we stack that up against many parts of the developed markets, actually there we see negative yields. So these yields, we believe, are pricing in a lot of risk. And I want to make that point quite clear because I think that the investment here is not premised on being bullish about South Africa's macroeconomic prospects. We certainly share many of the concerns of the audience and the presenters today about the high levels of poverty and social inequality, about the challenges to our education system and what that means for productivity, which has been declining, and also about the lack of political reform in key policy areas that are essential to deliver medium-term growth. So we certainly don't believe that the future is a lot rosier. What we do think is that bonds are pricing in a pretty poor outcome, and as a result of that, the starting yield and the prospect for good returns in the portfolio is very much there. Okay, so for the final slide, I just wanted to bring up the portfolio and the asset allocation over time. And really what I want to show you is that despite the views and the opportunities we see here, we are still constructing diversified portfolios, but that they do have good exposure to South African assets. And you can see that South African equity exposure is at a relatively high level relative to many years now. And I spoke earlier about that period around 2013 and 14 when our expectations or our upside to fair value was a lot lower. And you can see that at that point, the asset allocation to South African equities in the fund was certainly much lower. And South African government bonds too, you can see that versus history, much more exposure to that asset class today given the upfront yields that are on offer. And part of that funding comes out of something like cash, which offers far less attractive yields to investors. So an investment in the Balance Plus fund today will give you exposure to these asset classes. It's obviously been a very volatile 18 months. And as prices have moved quite dramatically, so have the exposures that we have taken in the fund to constantly take advantage of where we feel the market is mispricing a medium-term opportunity. As investors in the Balance Plus fund, you get exposure to these views at all times, and that's what you can see in the final slide. Thank you very much.